I do expect a pretty significant run here. For Bitcoin, most of the indicators that I tracked point to being fairly mid-cycle in terms of the bull run. And so I still think the next 18 months look favorable for the asset. Again, it tracks global liquidity pretty well. The on-chain indicators can show us, for example, how much long-term holders are selling into the current strength. Because even though obviously Bitcoin supply is constrained, if the price goes up, 3x or 5x in a fairly short period of time, you generally see some of those older coins start to come to market and start meeting that new demand. And we've seen some of that, but so far we've seen less of that in this cycle than in prior cycles. And I still think that there has to be a higher price to unlock some of these older coins to meet that demand. And so I would be surprised not to see six-figure Bitcoin over the next 18 months.
Renowned macro analyst Lyn Alden is ever bullish on Bitcoin, predicting its significant growth before the cycle ends. Alden forecasts Bitcoin reaching six figures within 18 months, a prediction she shared in her latest interview. With the upcoming halving reducing its supply, Alden affirms that demand will drive prices higher. Additionally, the approval and launch of the spot Bitcoin exchange-traded funds in the US have further fueled institutional interest and higher prices. Alden also analyzes the current macro situation in the US, anticipating more inflation challenges and affirming Bitcoin's position as a hedge against all the current economic uncertainties. Now, let's watch Lyn Alden share her expert insights on fiscal dominance, inflation, and the central bank's inability to solve the problem. While watching, please give this video a thumbs up, subscribe to the channel, and enable post notifications for more similar content. Make sure to stay until the end of the video for more insights from Alden on why Bitcoin's future looks bright in comparison to the current state of the macroeconomy. Thanks and enjoy.
I think we're going to have higher highs and higher lows of inflation than we had in the prior decade. That's how I would describe a secular inflation. And kind of a major thing I've been pointing out is questions I got over the past couple years were, are they going to get inflation back down to 2%? And my answer has generally been, I don't know, but I don't think that's the right question. I think the right question is, what's going to happen with inflation the next time we have an upcycle in PMIs, for example, like Manufacturing Purchasing Managers Index? Because I think that's the real test. You can get inflation down temporarily if you're willing to have a recession, if you're willing to disinflate enough. And that's kind of the pseudo cycle we've been on. It's obviously been offset by Fiscal, as we've been talking about. So they've not gotten it down to 2%, but they have muted it significantly. We're starting to see early signs of PMI reacceleration. Kind of rotation in what sectors are doing well. And so I think the big test is, if we get an upcycle in PMI, what does inflation do? My expectation is that inflation goes up or stays sticky when we get that next PMI rise. And so it's not a matter of, could they touch 2% sometime this decade? Sure. But the question is, can you sustain there and have another cycle of growth while still sustaining there? And I think that's the much harder thing. And so, because I think this is going to be a more energy intensive cycle, I think we're going to be more linked to what happens with energy than we have been in say the prior 10 years or so. And so I think my expectations, higher highs and higher lows compared to what we had in, say, the 2010s decade. Owning things like energy stocks, for example, or direct oil exposure, or gold or Bitcoin. These are the types of assets that I find more interesting to match with my equities in this environment, because the entire 60/40 portfolio is kind of designed around that structural disinflation, structural declining interest rates. And as we go to a new period, I think these other assets offset and kind of smooth out an equity portfolio better than just long duration bonds, which is, I think Bloodsport's a good phrasing for it. I call it the too hard pile. I put bonds in the too hard pile because if bond yields go up, there's other asset classes that I think will be more affected. And if bond yields go down, as Luke said, I'd want to own things like gold and Bitcoin. I wouldn't want to own, whatever move I could get in that long duration treasury yield. There's other assets that I'd probably want to own. And it also depends on what reason it was for those moves. And so I've just not been really using long duration bonds as a portfolio segment, even though I am acutely aware of things like recession risk or inflation risk. I find that other assets work better with the equity. I do expect a pretty significant run here. For Bitcoin, most of the indicators that I tracked point to being fairly mid-cycle in terms of the bull run. And so I still think the next 18 months look favorable for the asset. Again, it tracks global liquidity pretty well. The on-chain indicators can show us, for example, how much long-term holders are selling into the current strength. Because even though obviously Bitcoin supply is constrained, if the price goes up, 3x or 5x in a fairly short period of time, you generally see some of those older coins start to come to market and start meeting that new demand. And we've seen some of that, but so far we've seen less of that in this cycle than in prior cycles. And so I still think my expectation is there's room to run, both from the liquidity side being fairly constructive, so that should help demand. And I still think that there has to be a higher price to unlock some of these older coins to meet that demand. And so I would be surprised not to see six-figure Bitcoin over the next 18 months. Obviously, anything's possible, but I'm bullish on both gold and Bitcoin in that time frame.
Now, a quick intermission before we proceed with more updates from Lyn Alden. Another piece of the latest news you might also want to know about. In a recent post on X social media, formerly Twitter, Galaxy Digital CEO Mike Novogratz dismissed the recent market correction as a risk fish, expressing confidence in Bitcoin's ability to resume its uptrend. This correction marked the largest Bitcoin drop within a single session since the Silicon Valley Bank collapse, attributed to tensions in the Middle East. Iran's significant attack on Israel raises concerns about further escalation in the region. Novogratz hopes for calm heads to prevail, fearing a major conflict's onset. Despite this, Novogratz maintains his bullish outlook on Bitcoin, predicting it to surpass $100,000 in 2024, citing the momentum of Bitcoin exchange-traded funds. However, potential delays in U.S. Federal Reserve rate cuts, driven by inflation concerns and Middle East tensions, pose risks to favorable market conditions. With that, let us return to Lyn Alden's discussion on the macro situation.
The funny thing is that because we're, kind of largely in fiscal dominance now, I think that the emphasis on the Fed is in many cases like backward looking, that the Fed has been a bigger source for markets for a long time. But as we kind of enter this fiscal dominant environment, I'm increasingly less interested in what the Fed does around the basis point margin, and more interested in what's happening with the treasury market, more interested in what's happening with the size of fiscal deficits, and those kind of more structural things. So to the extent that the Fed, cuts rates a little bit, or if they even add some interest rate hikes to it, it's not really the answer in my view. I think basically that the large structural fiscal deficits are a bigger factor. And ironically, if they try to get down inflation by increasing interest rates, they're going to blow out the fiscal deficit even more. And so that's the lever that's different from the 70s, but closer to the 40s. And so for me, it's looking at, what are tax receipts going to be like? So for example, now because 2023 assets were pretty good, asset prices, we should expect decent tax receipts here, which ironically could narrow the deficit a little bit, which could give us, kind of a somewhat weaker performance in 2024 for at least some of these, like say, mega cap assets. I think those factors matter more. I think also we've seen, for example, some of the treasury decisions to shorten the average duration of their treasuries have had bigger effects on the market than what the Fed does in a given meeting. So some of these quarterly treasury releases have been bigger factors than the Fed. Obviously during kind of acute liquidity things, like for example, the early 2023 banking issue, that was both a treasury and Fed issue together. But in general, I think that overall liquidity, overall fiscal is actually a bigger force than the Fed. So I don't really have a firm view, let's say a -3 cuts or plus a couple hikes. That range is largely irrelevant for my investment decisions. Obviously, if we were to get major moves outside of that range, I would start to care again. But as long as expectations or my expectations are fairly somewhere in the middle, I think that's not the biggest lever to be focused on compared to what's happening in fiscal, compared to what's happening in, say, supply and demand of oil. Those I think are the bigger forces. Fiscal dominance would be less inflationary if it imploded the private sector. So, for example, by raising rates so quickly, they blew out interest expense, but they also killed some of the banks. But when those banks started to fail, instead of letting deposits that are uninsured go bust, they bail out the deposits. And so they kind of soften what happens on the private sector while putting the gas on the public side. And that's where you get fiscal dominance being more inflationary. So it could include things like SLR rules changes, kind of, financial jargon that helps banks hold more treasuries, which is also basically what they did in the 1940s. It wasn't just the Fed monetizing all the treasuries. It was other pools of capital, including banks. And banks, because they have fractional reserve, policies, that they can hold quite a bit of treasuries depending on regulations around them, especially if those treasuries are shorter term. I think recession or no recession is now more sector specific. When you have this big of a gap between fiscal and monetary, you can get sharply divergent sector performance. So, for example, commercial real estate's in a depression, whereas other areas are in an expansion, right? And so I think that we could see a rotation. For example, we are starting to see some weakness in the labor market. You're up from 3.4% unemployment to 3.8. Around the margins, some of that's getting weaker, perhaps, even as we see reacceleration in some of the harder stuff like manufacturing PMIs. So I would have not super high conviction on that, because I think even if we do get a recession, it looks different when you're pre-stimulating by $1.6 trillion in deficits. I think you enter a type of recession that looks like a fiscally dominant recession. So my view is even somewhat divorced from the business cycle, even though I'm, every 2 weeks, I'm kind of trying to aggressively map out, whether the economy is expanding or contracting. But I think that overall, when people ask about recession, they often think it's going to look like global financial crisis. It's going to look like COVID. It's going to be this big disinflationary recession. Whereas my expectation is it looks more like a 2001 recession, or it looks more like a 1970s recession. There's different magnitudes it can look like, but I think it looks more like those other types of recessions, even if you were to get one. But yeah, my answer would probably be I would expect higher inflation before recession, but not super high conviction. A challenging thing is that the dollar index is so tied to the euro. That particular currency pair weighs very, very heavily. So I'm more interested on a currency by currency basis. Like I think some of the Latin American currencies are less weak than people are maybe accustomed to at the current time. So I think that the worst the dollar move is probably behind us, which should be somewhat beneficial for all these entities that have these dollar-based debts that are maybe not in the most dire straits, but that are kind of teetering. I think a lot of them have gotten through the worst of it.
Considering the current macroeconomic situation, do you believe Bitcoin truly serves as a hedge against economic uncertainties? Why or why not? Feel free to share your thoughts in the comments section. If you found today's video informative and would like to receive more insights and updates on cryptocurrency and global finance, please consider liking the video, subscribing to our channel, and enabling post notifications. Stay tuned for our next episode, where we'll uncover more about the fascinating developments in the crypto space. Until then, keep questioning, keep exploring, and most importantly, keep investing wisely. Thank you for watching, and we look forward to seeing you in the next video.